If you observe carefully what's happening in the artificial intelligence sector right now, you'll notice something that should concern every serious investor. Nvidia's stock has risen 744% over the past 3 years. The company now commands a market capitalization of $2.2 trillion, larger than the entire GDP of Canada. And yet the most sophisticated institutional investors, the ones who got in early, who understood the AI revolution before it became obvious, are quietly reducing their positions. Not selling everything, not panicking, but methodically, deliberately taking profits and rotating into assets that most retail investors aren't even considering. This isn't about whether AI is real or whether Nvidia is a good company. Both of those things are true. This is about understanding market cycles, concentration risk, and the mathematical reality of valuations that have disconnected from fundamentals. What I'm about to share with you could protect decades of your hard work. This isn't a prediction. It's a logical consequence of patterns I've observed over more than 40 years of studying markets, building one of the world's largest hedge funds, and navigating every major financial cycle since the 1970s. When you understand incentives, you understand behavior. And right now, the incentives driving the AI bubble are identical to those that drove the dot-com bubble of 2000, the housing bubble of 2007, and the cryptocurrency mania of 2021. Consider these 3 data points. First, Nvidia's price-to-earnings ratio currently sits at 67, compared to the S&P 500 average of 24. Second, retail investor participation in technology stocks has reached levels not seen since March 2000, with individual investors accounting for 23% of all trading volume. Third, margin debt, money borrowed to buy stocks, has increased by $89 billion in the past 18 months, with the majority concentrated in 7 technology names, including Nvidia. These aren't random numbers. They're the signature of late-cycle euphoria, the moment when the smartest money begins to exit and the last wave of optimistic buyers enters. To understand what's happening, you need to grasp a fundamental mechanism that repeats in every speculative cycle. Think of it like a restaurant that becomes incredibly popular. At first, only food critics and industry insiders know about it. They get reservations easily, enjoy excellent service, and watch the value of their early discovery grow. Then food magazines write about it. Then social media discovers it. Soon there are 3-hour waits. The quality declines because they're overwhelmed. And the original diners, the ones who knew about it when it was special, they've already moved on to the next undiscovered gem. This is exactly what's happening with Nvidia. The institutional investors who bought at $150 per share in early 2023, who understood the AI infrastructure thesis before it became mainstream, they're not the ones buying at $875. They're the ones selling to retail investors who just read an article about how AI will change everything. The current pressures creating this dynamic are both mathematical and psychological. First, Nvidia now represents 6.8% of the entire S&P 500 index weight, a concentration level that creates systematic risk. When a single company commands that much influence, any stumbling becomes magnified across the entire market. Second, the company's revenue growth, while impressive at 122% year over year, is already decelerating. Third quarter growth was 94%, suggesting the exponential phase is transitioning to linear. Third, competition is intensifying. AMD, Intel, and custom chips from Amazon, Google, and Microsoft are all targeting Nvidia's dominant market share. Fourth, and most critically, the valuations assume not just continued growth, but accelerating growth forever, which historically has never been sustainable for any company at any time. History is an excellent teacher if you're willing to learn from it. In 1999, Cisco Systems was exactly where Nvidia is today. It was the undisputed infrastructure king of the internet revolution. At its peak in March 2000, Cisco commanded a market cap of $555 billion, making it the most valuable company in the world. The stock had risen 3,000% in 5 years. Every analyst had a strong buy rating. The company was genuinely revolutionary, selling the routers and switches that powered the internet boom. Everything the bulls said about Cisco was true. The internet was real, would change everything, and Cisco's technology was absolutely essential to that transformation. The growth story was compelling and the fundamentals were solid. And yet, from its peak of $80 per share in March 2000, Cisco fell to $8 by October 2002, a devastating 90% collapse. Not because the internet wasn't real, not because Cisco wasn't a good company, not because the technology failed, but because the valuation had disconnected so far from reality that even excellent earnings couldn't justify the price. Today, 25 years later, Cisco stock trades at $58. Investors who bought at the peak in 2000 and held through everything still haven't broken even after a quarter century. Think about that. The company delivered on everything it promised. Revenue grew, profits increased, the internet transformed society exactly as predicted. Cisco is still the dominant player in networking, but the entry price mattered more than the thesis. Timing and valuation destroyed returns despite a perfect technology bet. The 1970s offers another instructive parallel. The Nifty 50 were the unquestionable blue-chip growth stocks of that era. Companies like Polaroid, Xerox, IBM, and Eastman Kodak. These weren't speculative ventures or unproven startups. They were established, profitable companies with revolutionary technologies and seemingly endless growth runways. Wall Street analysts declared them one-decision stocks. You bought them and never sold because their quality was so superior that traditional valuation metrics simply didn't apply. Sound familiar? By 1972, these 50 stocks commanded price-to-earnings ratios averaging 42, with some exceeding 90. Polaroid traded at 90 times earnings. The argument was that these companies were so dominant, growing so consistently, that premium valuations were permanently justified. Then the bear market of 1973-1974 arrived. The Nifty 50 collapsed by an average of 66% from peak to trough. Polaroid fell 91%. Xerox dropped 71%. Avon Products declined 86%. These weren't dot-com startups with questionable business models. These were generational companies with real earnings, real products, and real competitive advantages. Polaroid continued selling cameras. Xerox continued dominating office copiers. But the valuations had reached levels that required not just growth, but accelerating perfection forever. And markets never deliver perfection indefinitely. Even excellent companies became terrible investments when purchased at infinite prices. To understand whether you should be holding Nvidia at current levels, you need to understand three fundamental principles. The first is the law of large numbers. When a company reaches $2.2 trillion in market cap, as Nvidia has, maintaining growth trajectories becomes mathematically improbable. To double from here, Nvidia would need to be worth $4 trillion, larger than Germany's entire GDP. Think of it like a tree. A sapling can double in size every year. A mature oak tree cannot. The laws of physics eventually constrain exponential growth. The second principle is mean reversion in valuation multiples. Nvidia trades at roughly 35 times sales. The average profitable technology company trades at 6 times sales. When you pay 35 times sales, you're betting the multiple will expand or remain stable. History shows that multiples compress during any uncertainty. If Nvidia's multiple merely returns to the technology sector average, the stock would decline 83% even if revenue stayed flat. The third principle is portfolio concentration risk and the mathematics of loss recovery. If Nvidia represents 40% of your portfolio and falls 50%, your entire portfolio declines 20%. To recover that 20% loss requires a 25% gain. If Nvidia falls 75%, exactly what happened to Cisco, and represents 40% of your holdings, your portfolio drops 30%. Recovering from a 30% loss requires a 43% gain. The mathematics are brutally asymmetric. A 50% loss requires a 100% gain to break even. Let me tell you a story that illustrates how this plays out in real life. In early 2000, there were two investors, both intelligent professionals in their 50s, both with approximately $800,000 in retirement savings accumulated through decades of disciplined work. Michael, a 52-year-old engineer working in telecommunications, was convinced that the internet revolution was real, and he wasn't wrong. His professional experience gave him deep insight into the technology. He concentrated 65% of his portfolio, $520,000, in Cisco, Oracle, and Sun Microsystems. His thesis made perfect sense. The internet was transforming everything. These companies provided essential infrastructure, and growth was explosive. His neighbor Susan, a 54-year-old hospital administrator, also believed in the internet revolution. She used email daily and saw technology improving healthcare systems. But she made a different choice about position sizing. She allocated only 25%, $200,000 to technology stocks, keeping the remaining 75% in what seemed boring at the time. Dividend-paying utilities, consumer staples like Procter & Gamble, real estate investment trusts, and treasury bonds yielding 6%. When Michael showed her his 127% returns in 1999, while she had gained just 14%, she felt foolish. The social pressure was intense. When the bubble burst in March 2000, Michael's world changed. His concentrated technology holdings fell by an average of 82% over the next 2.5 years. Cisco dropped from $80 to $11. Oracle fell from $46 to $9. His $520,000 in technology became $94,000. His total portfolio of $800,000 shrank to $310,000. At age 52, planning to retire at 62, he had lost $490,000, more than half his retirement security. The emotional impact was devastating. He couldn't sleep. His marriage became strained. Worse, the psychological trauma made him sell near the bottom in October 2002 and move entirely to cash, unable to tolerate watching the numbers decrease further. This is the hidden destruction of concentrated losses. They destroy not just wealth, but the emotional capacity to recover. Meanwhile, Susan's diversified portfolio fell only 18% to $656,000. Her technology allocation got hammered, dropping from $200,000 to $36,000, a painful $164,000 loss. But her bonds appreciated as interest rates fell. Her dividend stocks provided steady income. Her REITs held value. More importantly, because the loss was tolerable at 18%, she maintained discipline and continued dollar-cost averaging during 2001, 2002, and 2003, buying quality assets at depressed prices. 10 years later, in 2010, the outcomes were starkly different. Michael's portfolio had recovered to only $680,000, still below his starting point after a full decade. Susan's portfolio had grown to $1, $47 million. The difference wasn't that Susan was smarter about predicting the crash or had better stock picks. Michael had been completely right about the internet revolution. It transformed everything exactly as he predicted. The difference was that Susan's allocation reflected the fundamental uncertainty of concentrated positions in expensive assets. She understood that being right about the macro trend doesn't guarantee being right about timing, valuation, or which specific companies capture the value. Now, let's translate this to how it affects you personally and specifically. If you're 55 years old with $600,000 in retirement savings, and Nvidia represents 35% of your portfolio, you currently have $210,000 in a single stock, trading at 67 times earnings and 35 times sales at the peak of an AI enthusiasm cycle. Let's walk through a realistic scenario. Nvidia doesn't need to go bankrupt. The company doesn't need to miss earnings. It can continue growing revenue at 30% annually for the next 5 years, an excellent outcome by any measure. But if the valuation multiple compresses from 67 times earnings to the technology sector average of 28 times earnings, still a premium valuation, the stock falls 58% even as the business thrives. Your $210,000 becomes $88,000. Your total portfolio drops from $600,000 to $478,000, a $122,000 loss, representing 20% of your entire retirement savings gone. Here's what that means in practical, everyday terms. If you were planning to retire at 65 and withdraw 4% annually, the standard safe withdrawal rate recommended by financial planners, you expected $24,000 per year from your portfolio to supplement Social Security. After a 20% decline, you're at $19,120 per year. That's $4,880 less every single year for the rest of your life. Compounded over a 25-year retirement, that's $122,000 in reduced lifetime income. And that's assuming no further losses and no adjustment for inflation. But there's additional hidden impact. The psychological shock of watching a single concentrated position cost you $122,000 may cause you to sell other holdings at the worst possible time or become too conservative afterward, further impairing your long-term returns. This is the hidden cost of concentration risk, not just the direct mathematical loss, but the behavioral mistakes it triggers that compound the damage. Based on these principles, here are practical guidelines. If you currently hold Nvidia, consider this allocation. Keep 25% of your current position to maintain AI exposure. Rotate 40% into precious metals. Physical gold and silver split 30% gold, 10% silver. Allocate 15% to energy infrastructure and commodity producers like Exxon, Chevron, and Freeport-McMoRan, trading at PE ratios between 8 and 12 with dividend yields above 4%. Place 10% in Treasury inflation-protected securities with 5 to 10-year maturities. Position 10% in cash equivalents yielding above 5%. The precious metals allocation addresses currency debasement risk. When you hold stock at 67 times earnings, you own claims on future dollar-denominated cash flows. If those dollars lose purchasing power, even stable earnings become less valuable. Gold and silver can't be printed or programmed. Currently, central banks worldwide are buying gold at the fastest pace since 1950, adding 1,136 metric tons in 2022 and 1,037 tons in 2023. When you understand incentives, you understand behavior. Central banks aren't pessimistic about technology. They understand that $34 trillion in U.S. debt, increasing by $1 trillion every 100 days, creates pressure on fiat currency values. The energy allocation addresses inverse correlation to technology stocks. When inflation builds, commodity prices rise. When interest rates increase, high valuation growth stocks suffer, while cash flow generative value stocks hold up. The TIPS allocation protects purchasing power if inflation persists. With current TIPS yields around 2.2% above inflation, you're guaranteed a real return if held to maturity. The cash position provides psychological comfort during volatility and tactical opportunity during dislocations. What to avoid? Don't sell everything at once. Implement this rotation over 6 to 12 months. Sell 10% of your position monthly or 15% at specific price levels. Don't chase the next hot technology stock. The goal is portfolio resilience, not finding the next Nvidia. Don't wait for recovery to your purchase price before selling. Your shares don't know what you paid. The only relevant question, would you buy this stock at the current price with new money? Prepare psychologically for Nvidia to continue rising after you reduce your position. In 1999, investors who sold Cisco at $60 watched it climb to $80 before collapsing to $8. The pain of missing those last gains was temporary. The pain of riding it down was permanent. Your goal isn't maximizing every dollar of possible gain. It's building a portfolio that withstands multiple scenarios without derailing your retirement. Nothing in this constitutes specific financial advice. Every individual has different time horizons, risk tolerances, and tax situations. Consult qualified financial professionals who understand your complete picture before making significant allocation changes. Here's the philosophical truth that transcends any particular stock or market cycle. Wealth preservation requires fundamentally different skills than wealth creation. Making money demands optimism, conviction, and concentration. The willingness to bet big when you see opportunity. Keeping money demands skepticism, humility, and diversification. The wisdom to acknowledge uncertainty and position for multiple outcomes. The mistake most investors make is continuing to employ wealth creation strategies after they've already accumulated substantial assets. A 35-year-old with $50,000 can afford to take concentrated bets. They have time to recover from mistakes, decades of future earnings ahead, and limited capital at risk. A 55-year-old with $600,000 faces an entirely different reality. That $600,000 represents their life's work, their retirement security, their healthcare funding, potentially their legacy for children. The stakes are completely different. The choice is yours. But remember what's happening beneath the surface while retail investors chase AI stocks. Institutions are already rotating. Sovereign wealth funds, the most patient, sophisticated capital in the world, increased gold allocations by 14% in the past 18 months. Central banks worldwide purchased more gold in 2022 than any year since 1950, with continued heavy buying through 2023 and 2024. The People's Bank of China has bought gold for 17 consecutive months. Major university endowments managing multi-generational wealth reduced public equity exposure from an average of 41% in 2021 to 34% in 2024, shifting into alternative assets, real return strategies, and hard assets. These aren't retail investors reacting to headlines or CNBC segments. These are the most sophisticated allocators in the world, managing hundreds of billions or trillions of dollars, making decisions based on mathematical reality rather than narrative excitement or momentum. When you understand incentives, you understand behavior. And their behavior right now is revealing a truth they see coming, but most retail investors don't yet recognize. That's why this channel exists. Not to predict the future with certainty, no one can do that reliably, and anyone claiming otherwise is selling you something. Not to tell you exactly what to buy or sell, that depends entirely on your unique situation, your risk tolerance, your time horizon, your tax circumstances. But to observe signals before they become obvious to everyone, to identify patterns that repeat across market cycles with mathematical precision, and to share frameworks for thinking about risk that can protect what you've spent decades building. The crowd will understand these dynamics eventually. They always do. But typically only after the pain has already been inflicted, after portfolios have been permanently damaged, after the easy exits have closed and liquidity has dried up. We observe signals while they're still signals, not after they've become sirens blaring at full volume. If this analysis makes sense to you, if you value frameworks for thinking about markets rather than hot tips and predictions, if you understand that wealth preservation is ultimately more important than wealth accumulation once you have something meaningful to preserve, consider subscribing. The next few years will separate disciplined investors from hopeful speculators. The difference between those groups isn't intelligence, market access, or information advantages. It's the willingness to accept mathematical reality even when narratives are seductive, to position for protection even when offense feels better, to remember that wealth preservation is the ultimate offense when you already have something valuable to preserve. Your Nvidia shares might continue rising for months or even another year. I genuinely hope they do. But hope isn't a strategy, and current valuations aren't sustainable indefinitely. The question you need to answer isn't whether AI will transform the world. It absolutely will, just as the internet, electricity, and automobiles transformed the world before it. The question is whether current prices appropriately reflect the probable range of outcomes or have disconnected into pure speculation territory that requires absolute perfection to justify. Based on 40 years of studying markets, building portfolios through multiple complete cycles, and understanding the mathematics of valuation and the psychology of crowds, I believe we're much closer to March 2000 than we are to 1995. The late innings, not the early ones. Act accordingly. Protect what you've built. The opportunities will always exist for those with capital preserved and ready to deploy when fear eventually replaces greed, and quality assets trade at reasonable prices again. That's the advantage of patience and discipline. You get to choose your opportunities rather than being forced into desperate decisions.